private equity panel, which is focused on real estate.
Thanks, John. Good morning, everyone. We're going to keep the discussion going, kind of lively. Today, I'm joined by Zach Swartz. He's a partner at Vincent & Elkin, down on my right, furthest right, and Ron Burgett. He's Senior Vice President of Choice Hotels International. And we're going to be talking about the intersection between private equity and real estate. But before we get started, I just wanted to pass it over to Zach to share a little bit about his background.
So thank you. Great to be here. So I'm, as Katrina mentioned, I'm a partner at Vincent & Elkins, based out of our New York office. Focus on sort of a corporate transactional focused practice with, primarily an industry focus with clients in the real estate industry. Practice kind of spans the whole sort of life cycle. So, we represent a lot of sponsors, in connection with, the formation, sort of structuring of a vehicle that might invest in real estate or real estate related assets, private capital raising that they might go, to kind of capitalize that entity and go out and actually acquire real estate, on through hopefully, at some point an IPO. Then we typically stay on as sort of outside corporate counsel, help them with their SEC compliance, corporate governance, things like that, follow on, private capital raising. And then we work on other exits as well, right? So, I think Lawrence mentioned, Lawrence is my partner, by the way, great guy, obviously, although I have to say, he had a lot more people on his panel, so I'm gonna have to, usually he works much harder than me, but I'm actually gonna have to work much harder than him today, which is kind of a rare situation. But, Lawrence mentioned there's been a lot of, REIT M&A, and I've actually worked personally on quite a bit of M&A in the public REIT space this year as well. We do a lot of joint ventures and things like that as well. So that's a little bit about my practice.
Thanks, Zach. Ron?
So yeah, I'm Ron Burgett. I've been with Choice for about 20 years total, kind of on and off. I left for a while, became a commercial broker in real estate. Choice Hotels, those that you may or may not know, I know you know our brands probably, Radisson, Comfort Inn, Quality. We're mostly mid-market and economy, which has kind of outperformed the market. And then the last several years, at least the last 4 or 5 years for sure. We have brands that are all over the world. We're in 22 countries. I am in the senior team. I actually focus, over the last 5 years, my focus has been extended stay, which has been kind of the sweetheart of the hospitality industry. They have continued to outperform the industry all the way through COVID. Matter of fact, our revenues went up, not down, which is good and bad. We already knew that. We already went through 2008 and some other cycles. So it kind of got out there and got pretty public, and we're a publicly traded company, so we like to talk about what we do well. So now we got a lot of competitors in the space. So we were early adopters back in 2000, curated economy brands that do very well and they stay full, and we continue to be kind of a leader in the space.
Great, thank you. So we're here to talk about the intersection between private equity and real estate. So Zach, can you tell us a little bit about how your work fits into that?
Yeah, so our clients kind of span the gamut. So we have some private equity clients, that sponsor the vehicles that I was kind of talking about earlier. Even family offices. Sometimes we work with the investment banks that work on the transactions. But a lot of it is someone comes to us and says I want to start I want to invest in real estate. And they might come and think I want to be on the management team of a private REIT. Or I want to be the GP of a private fund, and a lot of that is sort of educating them, like is that actually the best structure for you? What are your actual sort of long-term goals? And getting them in the right structure at the beginning is actually very important. A lot of times we actually sort of push clients away from the REIT model. We have a ton of REIT clients, but that's not all we do. But we actually push them away from the REIT model because it's very restrictive in terms of what you can invest in. There's a lot of ownership limitations and things like that you have to really be careful about. And say, go ahead and start a fund initially. Put the assets in the fund, and then you actually have flexibility down the road. When you raise capital, right? All the LPs in your fund are going to be question A, B, and C is going to be what's the exit, right? What's the liquidity event down the road? And so, if you have assets in a fund, you can absolutely roll that into a REIT and take it public, 3, 5, 10 years down the road or whatever the sort of the fund, term is. And then, along the way, right? So, you form your vehicle, you start acquiring assets, you're going to need help, sort of on the asset level, right? So, we have a great real estate team at V&E with lawyers in New York and Dallas that, can work on, the actual, asset acquisitions and financing that you need to accomplish that. There's a ton of regulatory considerations that apply to, people that operate in the real estate industry, and it's growing, constantly. It seems like every other day you turn around and there's some kind of new pronouncement coming out from the federal government or the state level, even local level, right, that could affect, participants in the real estate industry. So you have to have a good sort of stable of regulatory lawyers as well. And then the last thing I'll mention, we don't have any of our tax partners here today, but when I'm sort of in the trenches advising clients, that's a big, for people in the real estate industry, taxes are just, a huge focus. And so, that's another, place you really want to be buttoned up on. You want to have good tax legal advisors, tax accounting advisors, sort of across the board.
Thanks, Zach. Ron?
So yeah, kind of zoning into our extended stay side of our business. We have about 500 locations. I think one of Zach's clients is one of our largest franchisees. Most of what we do is we're asset-light company. So most of our business in extended stay is with private equity and family office. That's kind of surprising if you hear a hotel guy say that. Most of our guys and even our largest franchisees that may have up to 50 locations with us, they don't call themselves hoteliers. They're asset managers, they own assets. They're usually in it for the long haul. These things transact at cap rates around 8%. Even still today, we've had them as low as 6% in large packages. So, our investors kind of stay with us, and again, we focus our development to kind of look at what a private equity firm such as ServiceStar out of Denver, one of our largest franchisees. We look at their management team. What do they want from us? So they're looking at return on investment, yes, but are they looking for growth? We look for heads in beds. That's, we're a hotel company. We do want that. But at the same time, we're looking at the bottom line. We're looking at return on investment. So everything that we do, we actually do ourselves too. We have some assets. We own several hotels, and it's kind of a good training ground for us. But we learn from our franchisees. We learn more from them than they do from us, and we're just the platform for them to continue to grow their businesses.
Thanks, Ron. All right, so I think we should move to what's top of mind for everyone this year, interest rates. I've read a ton of articles this week about whether or not there's going to be further hikes, but one of the articles I read talked about that we should be a little bit more concerned about interest rates staying higher for longer. And I know we know the story this year in commercial real estate focused a lot about interest rates and the challenging environment that it created. So, Zach, I'm going to pass this over to you, but I'm curious to see as we move into next year how you see interest rates affecting, the investment decisions that your clients might be making and how you're advising them.
Yeah, to me, the story there is uncertainty, right? Every now and then you'll sort of hear this consensus emerge, like, no, they're going to be higher for longer. No, they're going to hike at the next meeting, or they're not going to hike, or they're going to pause, or they're going to start cutting. Like, no one knows for sure, right? And to me, it really feels like we're living from, one Fed meeting, one jobs report, one inflation report to the next. And, you see these like big market moves, whenever the Fed meets and they keep rates the same or whatever. And so it's just a very uncertain time as it relates to rates, whereas, I guess starting 2 years ago and then the preceding 10 years, it was like, well, rates are always going to be zero, and that was sort of really a great time to be able to kind of go out and raise capital. And, someone has once said to me, the capital markets hate uncertainty, right? So I think there's been one REIT IPO in the past 2 years, right? I think that's a big reason why. There's a lot of uncertainty about, sort of the current, environment for rates. And, we have a lot of public REIT clients that, follow-on activity is just really down as well. And I think that's going to continue for as long as there's uncertainty. In terms of how we're advising clients, it sort of depends. I kind of put our clients into two buckets. So, bucket one is, the clients that were, already kind of mature, had a portfolio that was, sort of constructed when interest rates were, zero or at zero, and really, the advice to them and, was, they needed to be acting probably 2 years ago or frankly longer to kind of start to manage the portfolio for what is really starting to hit, I would say, like now and into 2024 and 2025. Where, you had, sort of asset level debt that was going to come mature late 23, 24, 25. And the idea, most people might know this, but a lot of commercial real estate is sort of interest only until you reach maturity. And sort of the business model was always, well, when we hit maturity, we'll just refinance because interest rates will be zero. But now you're hitting a situation where rates are 3-4 times what they were whenever you put the debt on the asset. And so you needed to kind of get out in front of that. And we had a lot of clients that did that, like in late 2020. One of the clients I work with a lot, commercial mortgage REIT. As of January 1st, 2020, more than 50% of their portfolio was in office debt. So they've had a challenging few years here. They've sold loans at significant losses. They've, it's been tough. Their stock price is trading way down. It's been tough for them, but they got ahead of it. They pushed out, corporate level debt, right? They went to their, lenders at a time when it was still, in 2020 rates were still pretty close to zero or effectively zero, and they said, can we push our maturities out, into 2025, 26, and we think rates will come back down. And that was, just a huge move for them, and it's given them a chance to survive. It's not been a fun few years, but they have a chance to survive. So that's sort of group one. Group two is there's a ton of sort of private capital that's been raised, by private equity funds. We have a family office client that we just got engaged, and the whole thesis is this distress and disruption is going to present a lot of opportunities to go out and scoop up assets kind of on the cheap, right? And so for them, it kind of goes back to what I was talking about before, right? Make sure you're in the right structure, make sure you have your sort of marketing materials, well honed, you have your, strategy, kind of locked down, and go out and raise capital, because there actually is a lot of capital on the sidelines that's looking to get, kind of deployed into strategies like that.
Thanks, Zach. Ron, how are you thinking about the portfolio given the current market environment, and then also thinking about next year and some of the distressed assets that Zach was talking about?
Yep. So yeah, interest rates obviously have affected our business. We're mostly a new construction model, especially for our Wood Springs brand. That's our hottest brand in the segment. Right now, we're about 94% of every ground break in the United States is a Choice product and extended stay. Those developers are typically high net worth, again, family office, private equity type clients. That a few of those have kind of said, you know what, cash is king, I'm going to sit on the sideline for just a bit. But stepping right in have been other folks that have said, no, I want to get in, now is the time. Construction is still pretty hot, but it's slowing down just a little bit. So, we're trying to provide opportunities where currently the supply right now is half the demand. That's not going to change, we don't see, for the next several years. So, we're going to look for hot markets such as South Florida. It's, it'd be great to be talking to you guys, maybe 4 years ago when the market was a little hotter down here, where you could at least get in. But there's still very key markets that, we have a real estate team out finding great sites. But we're looking coast to coast. The West Coast is really hot right now as far as coming into extended stay. Again, the demand is so high. So, you can't keep developers down, especially these guys that have the money to put into whether you be a REIT or a family office, private equity. They need to spend some money. That's how they make money. So we're trying to capture most of that business. And we have some competitors out there, but if we can find the right location that cash flows with a low operating model, there's plenty of business out there for us. One other thing too that Choice has done, and we did this about 4 years ago, kind of before this interest rate issue, is we converted some of our early brands that were extended stay into more transient type, to move a transient product into extended stay. So we have like a model called Kitchen in a Box. So we're going to our top developers that have maybe 40 or 50 hotels that are running in the transient segment. Let's get into extended stay. We can show you how it's more profitable. And then we have worked with our vendors to kind of literally put a kitchen together. Most of this is in Wichita, one of the big companies we're working with, and we literally on a truck mail like a kitchen to their hotels, and we convert an extended stay product from something that was just transient and not making a lot of money. So again, long answer to your question is we're still focused on new construction, but there's a lot of conversion opportunity because of the demand-supply imbalance.
Thanks, Ron. Zach, what about sort of some of the legal challenges that Ron was talking about in terms of conversions? Is there anything to add there, or how do you look at that from a legal vantage point?
Yeah, I mean, there's a couple of things that I would think of. I think zoning is a big thing. That's not really sort of a focus of mine, but zoning, getting kind of local governments kind of behind those kind of changes is something that a lot of it depends on the jurisdiction, right? I mean, I think New York City is it's just crazy, right? Like you come into this. I've never been to West Palm Beach before, and flew in and took an Uber in and. There's like 3 office buildings like right around here that are being built, and I spend a lot of time in New York City, obviously, and like it's like foreign to me, but like New York City, they're a good example of a jurisdiction that's kind of seen this coming and says like, we need to figure out a way to, there's a ton of what used to be very valuable real estate, in Manhattan or wherever that, we need to figure out sort of a productive use for, and so, they've been taking steps to kind of actually facilitate that and allow, sort of developers to get in there and actually make that happen. I think it's very challenging. It's like those buildings were not made to be apartments. They're just not. So, you have like internal rooms in these like, converted apartment buildings where there's no windows, like stuff like that. So it's challenging for sure. And then the other thing is like, I'm always sort of focused on sort of like capital rate, like, we have a lot of public companies like SEC disclosure and things like that. Like, did you ever tell your investors that this, and like, how could you have? Like, how could you have seen COVID happening and, like kind of, this like serious retrenchment in the office sector? But like, what did you tell investors about, kind of what the assets that they were going to be indirectly owning would look like? And, are you sort of keeping them up to date on what you're doing to kind of manage your way through this kind of like unprecedented situation?
Staying with you, Zach, are there any other real estate subsectors that your clients are focused on right now? Where are you seeing a lot of interest?
Yeah, so I'm glad we talked about office. I did really want to hit on that. That's sort of, I think, the opposite of what your question was, but I would just absolutely be remiss.
Could be the ones that they're staying away from, too.
Yeah, right, yeah, so for sure. Although, like I said, I mean, it's kind of crazy to come down here and see all the construction that's going on. Another big one is multifamily, right? So, big story right now. We've been talking about rates a lot, as I would expect on any sort of real estate panel right now. But, I think for, a 30-year mortgage, you're probably looking at rates that are like, highest we've seen in 20 years or something like that, right? So, and if you'd have told me that, 2 years ago, that you had rates that were, at a 20-year high, I said, oh, well, when people were trying to buy houses in 2021, right, it was like you had to put an offer like with like multiple escalation clauses, and like that was your only chance to actually get, because there was so much demand and so little supply, right? Well, somehow, right, like there's just not enough supply to meet the demand, and so we have rates at like, I don't know, 8% or whatever it is to get a 30-year now, and you still can't buy a house even if you're willing to pay that, because there's just not enough demand, supply to meet the demand. And so what does that mean? Well, multifamily, right? Like apartments, right? That should be like a very hot sector, and it has been. But that is like a sector that a lot of people were just really high on, 2022 earlier this year, and then you start seeing articles coming out over the summer, right? Like, well, this was like financed with debt that was really low rate, and now it's coming mature in 2024 and 2025. So now we think like multifamily is maybe the next sector that's going to get hit with distress, and another thing I saw was there's a significant amount of overbuilding, right? Like, it seems like the real estate industry is kind of like the Titanic. Like, it starts to, it makes a move. It's like, well, we need more, residential, properties, so we're gonna like start funneling capital into building, a ton of multifamily apartment buildings, and by the time realize that maybe that's like sort of overheated. It's like a little too late. So, multifamily is the one that comes to mind. But I do think, you are starting to see articles come out, Wall Street Journal, Commercial Observer, talking about like that could be an area of actual distress in the next couple of years as well.
Thanks, Zach. Ron, I know you have a subsector perspective, but I also want to make sure that we touch on hospitality because I was told we have 5 minutes.
Okay. Yeah.
But I know that they're operationally intensive and also tied to sort of the performance of the broader economy. So first, your subsector focus, and then also what you're saying about hospitality to others who say it's risky.
Yeah. So subsector. I mean, we've never really had the downturn yet. I mean, we're a little less on new construction, but we were able to, like I said, do the transient conversion hotel business. Has been very good for Choice. Matter of fact, we just nearly doubled where we are with extended stay hotels in our portfolio. So there's business out there. As far as new sectors and what we're looking at getting into mid-market for the first time at Choice. We were pretty confident in what we were doing with economy. Again, very profitable business, not sexy. And we're not, when you tell we like to say, hey, you tell your banker you have a WoodSpring, you may tell your neighbor you have a Marriott product. We want to be one of those people that are always pretty profitable, and we're a good hedge against tough times. That segment's not going to change, and so we're still focused on what we do. I think on the overall, where do we go next? Mid-market is where the biggest opportunity is in extended stay. Right now, 15% of the business that's out there is new, so the rest of it is over 15 years old. So we actually developed, in the middle of 2020, we launched a brand called Everhome Suites to kind of go after that mid-market business that can go after infrastructure, rebuilding, the reshoring of American jobs, those kind of things. We think the demand is there in mid-market, so we're aggressively going after that. And we have 60 projects under construction.
Thanks.
In development.
Thank you. Zach, you mentioned earlier you were driving around and noticing all of the commercial real estate that's popping up. A lot of the Northeast, probably many people in this room, have relocated down to Florida or the South. And I'm just curious what challenges there may be for people that haven't already moved down, or what you're telling clients about trying to capitalize on opportunities in this region.
Yeah, it is interesting. We actually have seen clients that are sort of gearing up, raising capital around this thesis that we're going to focus on the Sun Belt, the Southeast, because the commercial real estate market down here is actually super hot, right? But to me, it is you can't just make sort of broad generalizations and sort of sweeping statements about it, because there actually is some nuance to it. So you can't you have to really hone your marketing materials if you're going to raise capital around that thesis right now, and be very thoughtful. And I have a specific example in mind, which is actually Viennese, Texas-based firm. We have offices in Houston, Dallas, Austin, and sort of the joke that we make, right, is COVID never existed in Texas. So they were highest office attendance rates in the country over the past few years. But there was just an article in the Wall Street Journal, I think last month or 2 months ago, that said that Houston has the highest office vacancy in the country, which actually just blew my mind. And the reason isn't office attendance, like what the issue might be in New York or San Francisco. The issue is overbuilding. So they overbuilt at a time before, whenever they thought we're gonna be able to fill all these offices up, right? And so that's something to be sort of wary of, right? It's not all sunshine and roses in the Sun Belt. There's a little bit more to it than that.
Ron, your thoughts?
Yeah, so the Southeast has been very strong for Choice. I was looking at, just a couple of days ago, looking at the 400 WoodSpring products that we've had over the last couple of years. Nearly 30% or so are all in South Florida area or in Florida. So we don't see any weaknessing of the market here. We think it's going to continue to expand. Again, the secret is kind of what you said, is make sure you put it in the right market. In our specific subsectors, extended stay, it's not for every corner. It's not like a Hampton Inn or a Comfort Inn that you can put anywhere that people are going to come stay at, a transient type business. Our business is long-term stays, so we want people to stay with us up to 30 days at a time, and we have that in most of our locations, running 90% occupancy. That's very strategic in where we can put those products. So we have a real estate team, again, going out and looking exactly where are the top 20 areas in South Florida to be. Just using Florida, for example, we do that across the country. And there's, like I said, there's still plenty of room for growth. And again, we're seeing it hitting on all cylinders. Most of the customers that do new business down here are already doing business with us. However, so, out of the 500 extended stay, we have about 30 active developers. And that's, we kind of like to keep it that way because we're not re-educating them on how profitable the business is. We're not starting from scratch. And there's plenty of demand. So that's kind of where our focus is to take care of our top clients.
All right. Well, thanks. I wish we had time for questions, but I'm sure you can find Ron and Zach after this or after lunch. So thank you both for your time.
Thank you.
Thank you.